Hello again, everyone, and welcome to Neddle, the best platform around for distance learning in business, finance, economics, and much, much more. My name is Sava, and today we're continuing our discussion of risk management and measurement in banks and financial institutions. Today, we are discussing a very recent concept that has been developed regarding operational risk measurement by the Basel Committee for Banking Supervision and that not everyone has yet wrapped their head around. So, to cover this gap in educational materials, I guess, I would like to show you how banks calculate the business indicator component, and the internal loss multiplier that are currently the recommended techniques to use within the standardized approach for operational risk measurement. These formulas are something that banks use to figure out how much capital they need to reserve for potential operational risk events, for potential losses that can be associated with cybercrime, fraud, internal or external, unexpected events, or general unforeseen circumstances that are unrelated to any other general types of financial risk that financial institutions are exposed to. So, as usual, operational risk measurement is relatively vague and uses lots of various proxies to kind of get at least a plausible assessment of what are the likely losses that a bank can incur and how much does it need to keep within reserves as Tier 1 capital, basically, to provide for those potentially harmful events. Back in the day, when the old standardized approach or even the basic approach was used, banks were advised to resort to gross operating income as their proxy for operational risk. Well, the higher the gross income is, the higher is the size of the bank, so probably they can lose more on operational risk events. At least that was the logic. Well, then it has become clear that it's not the whole story, and business activities vary in terms of their riskiness from bank to bank. $1 million of gross income gained through retail banking, for example, might not be as risky as $1 million of gross income gained through derivatives trading or corporate finance activities, something like that. So then the basic approach gave way to the initial standardized approach where all bank activities were separated across a number of business lines. Each of them had their own capital risk weight that determined how risky is this particular business line. But it could be argued that those business lines definitions and those capital weights in particular were kind of arbitrary and did not reflect fully the risk profile of various banks. For example, commercial banking can be risky in one bank and less risky in the other bank. We are, again, kind of going through the same issue as we did with credit risk in Basel II, when there were predetermined capital weights for various credit ratings and various industries, but why the weightings are as they are? What do they really reflect? That was one of the major criticisms of the early standardized approach. Later on, as with many other types of risk, the Basel Committee for Banking Supervision allowed the advanced measurement approach that basically gave the banks the carte blanche to design their own models to measure operational risk and just approve these models with their regulators. But soon it became clear that it's also not the ideal solution, as a wide array of potential models to measure operational risks using sophisticated loss databases has emerged, and the regulators couldn't really grasp the multitude of the models banks developed. And it was suspected that the banks just use overly complicated models that no one except them can understand to lower their apparent risks and reserve less capital for the operational risk exposure. Because, well, why on earth would you say that you're taking as much risk as you're really taking if you could basically shove it all under the floor using a sophisticated computational technique? So then the advanced measurement approach was scrapped, and soon all the banks will be following the revised standardized approach, the business indicator. It can seem relatively complicated at the first glance, but that's my aim today, to guide you step by step through the procedure of calculating it, explaining where each of the components comes from and where you can find it in publicly available corporate disclosure. Our example would be HSBC, a very famous UK headquartered international bank, and we'll try to calculate the business indicator and the operational capital risk charge for them using the data they provide. First of all, I'll basically explain which variables do you need to calculate the business indicator. Well, first of all, you need three variables that correspond to bank lending and borrowing. So basically, it's the main business activity any bank pursues. To do that, you'll need interest earning assets, interest income, and interest expense. And they could be found somewhere at the start of the annual report, and interest income and interest expense can be found somewhere at the statement of profit and loss if you look closely enough. Here I have provided the page numbers where you can find those disclosure elements for HSBC in particular in their 2019 annual report that has been released a couple of months ago. Then we would need dividends received by the company from the assets that it holds. And here it's important not to be confused because one of the disclosure elements that is available is dividends received from subsidiaries. That's not what you're looking for. You're looking for dividends received from assets that the company holds. And most of the time, those are disclosed at the notes after the statement of profit and loss. In our case, somewhere at the end of the annual report on page 232. That's pretty much all that we can retrieve from publicly available disclosure regarding the interest and dividend income of the bank. As you can see from this formula has four letters, ILDC. ILDC stands for interest, lease, and dividend component. Lease component would start to be available in the years to come as banks adopt new international financial reporting standards and they start distinguishing lease income out of other operating income. As for now, very few banks do that, and we can just neglect that as for now in calculating the business indicator. But in the following years, we'll start seeing lease income as an standalone disclosure element for many banks. Then we need to look at the fees that banks charge or have to pay. So fee income and fee expense that can be also consulted from the statement of profit and loss, page 229, in case of HSBC 2019 annual report. And we also need other operating income. If the bank reports other operating expense as well as other operating income, it would be really good for the calculation of the business indicator with high precision. But in our case, HSBC just reports other operating income. Again, I can't stress that enough. When you try to measure risk exposures of banks as an outsider, you have relatively limited access to data, to refined and disaggregated variables. So most of the time, you have to get satisfied with proxies or calculations that are less precise than you could have made by being an insider within a bank, an analyst, risk manager, whatever. And sometimes you have to make assumptions regarding the structure of the data that you analyze. Here, we just have to rely on other operating income without having any particular data on other operating expense, which is unfortunate. But again, it may differ from bank to bank. So when you are analyzing yours, please try to find whether they report other operating expense as well. Later on, we need to figure out the breakdown of bank's net profit into the net profit of the trading book and net profit of the banking book. And it can seem a little bit overwhelming at first, but it's easier to proxy than you think. Because, as Basel suggests, the definition of the trading book, and therefore the profit from the trading book, is very narrow. So you could just find out the profit, the net profit of the trading book, and then kind of reverse engineer the net profit of the banking book by just defining it as all profit that's not from trading activities. So here, net trading profit can be estimated as net profit from trading and securities held for sale, which is a very common disclosure element. So you can just rely on this as your net profit from the trading book activities proxy. And then if you find the net profit from the same statement of profit and loss, you could estimate that non-trading profit by just subtracting the net trading profit from net non-trading profit. And that's how you can figure out net non-trading profit for each of the years. Also, as for all operational risk measurement techniques, it basically inherits it from a basic approach long time ago. The operational risk measurements are concerned with 3 most recent years of data. So here we have retrieved this data for each of those variables for 2019, the most recent figure, 2018 and 2017. For most of these figures, you'll be able to find the data for 3 previous years in the most recent report. For some of the data, though, you might just get the data for 2019 and 2018, but that shouldn't discourage you from looking at the 2018 annual report and finding there data for 2018 and 2017 respectively. And then we just need to average all of those variables out across the 3 most recent years. And we have already done that for all the variables that we've got from disclosure. And for net non-trading profit, we can just average the results that we've just got from subtracting net trading profit from net profit. So now, why on earth would we need so many variables? Well, turns out that the calculation of business indicator is not as straightforward as the calculation of gross operating income, for instance. This concept inherits a little bit, to some extent, the logic of business lines that was in place in the early standardized approach. But what it does, it basically separates the bank's business model into 3 components: interest, lease, and deposit component, financial component, and services component. Perhaps the most straightforward of them all would be the interest, lease, and dividend component. So to do that, we just need to account for each of those 3 capital letters in the abbreviation. So first of all, we need to acknowledge the interest component. To do that, we would need to find the minimum of either the average interest earning assets times 0.035, so 3.5%, or the absolute value of net interest income, so the absolute value of interest income minus interest expense. What is the logic of this procedure? Well, you either take the net interest income averaged over 3 years and take absolute value taken. Or if your interest margin is very high, the business indicator does not penalize you for that and just caps your interest margin at 3.5% of your interest earning assets. So in that way, the business indicator measures the size of the bank more accurately. So it measures not how high is its interest margin, but rather how much can it earn from its interest earning assets. That is basically the logic. Then, if all banks would have completely adopted the new international financial reporting standards, would have added the absolute value of net lease income, so lease income minus interest expense. But for now, banks report it within their other operating income. We can just ignore that, neglect that as for now. It would not influence the calculations too much, as lease income is traditionally not a large proportion of banks' income, as they rely more on lending or investment. But what we need to add is the average dividends received over the past 3 years. And that would be our interest, lease, and dividend component. So we are done with that. We can see that in $1 million, this bit of the component is $31,808 billion. So almost $32 billion regarding interest, lease, and dividend component. Now, let's consider the financial component. The financial component revolves around summing up the absolute profit, absolute net profit of the trading book and the absolute net profit of the banking book. Why is it concerned with those two components? Well, because even if you make a loss on banking or trading books, then you still have to acknowledge that the bank is large enough to maintain high volumes on both of those. So that's why you take the absolute value and sum them together, so that the losses do not compensate for each other, but rather add up on top of the profits to reflect the size of the bank, not necessarily the profit margin of the bank, basically. So without further ado, we can just sum the absolute values of the average trading profit over the past 3 years and absolute value of average non-trading profit over the past 3 years. And we can see that the financial component is almost $12 billion. Now we can calculate the unadjusted business indicator that would be unadjusted for the services component. To do that, we need to add those two together, and then we need to also account for other operating income or other operating expense and fee income or fee expense. So we add the maximum from fee income and fee expense, and we would have also added the maximum from other operating income and other operating expense. But as we just have other operating income, because of the disclosure nature for this particular bank, we can just add other operating income to that. So that would give us the unadjusted business indicator. Now, having already calculated the unadjusted business indicator, we can figure out the final component of our business indicator proper, the service indicator, which would again revolve around other operating income or expense or fee income and expense. So what to do here? First of all, again, the maximum value from other operating income or other operating expense. As we haven't got the latter, we are just former. And then we need to add this complicated formula with a bunch of max and min functions. But let me explain what is the logic of this function. Well, what this function does is it prevents banks that rely a lot on fee income in their business models, so mostly banks that are heavily involved in fintech, for example, small challenger banks, from having too high of business indicators. So here, this formula accounts for the fact that if the uh, fee component or the services component would be too high of a proportion of the unadjusted business indicator, it would basically uh, shrink the services component and reduce the business indicator proper, so that challenger banks and companies that revolve on around fintech and rely a lot on fee income would not be penalized too much in terms of operational risk charges. So to apply this logic, we need to apply the max function. And first of all, the first argument of this max function is the absolute value of net fee income. So fee income minus the expense. Then we need to consider the minimum of the whatever whatever is larger, fee income or fee expense, and the equation that basically checks how prevalent is fee income within the unadjusted business indicators. 0.45 times the unadjusted business indicator plus 0.1 times the same, whatever is larger, income or fee expense. And then we can close a bunch of brackets and apply the formula. And now we can calculate the business indicator as the sum of income, lease, and dividend component, services component, and financial component. And we see that in our case, the business indicator proper and the unadjusted business indicator are the same. Because for HSBC, a well-established bank that has been around for more than a century, fee income is not such a prevalent source of income. It's not that relevant for its business model. So our unadjusted business indicator and our business indicator are exactly the same. And it should not confuse you, or you shouldn't worry about it if you are analyzing a well-established bank. Most of the time, those banks will gain most of their income from either from their interest earning assets or from their investment activities. For smaller, younger challenger banks, fee income can be more significant, and then the business indicator would be smaller than the unadjusted. So now, as Basel has all of its guidelines and thresholds that we use to determine bank size in euros, not in dollars, and HSBC has US dollars as its reporting currency, we need to adjust the business indicator to billions of euros. As here we have business indicator in millions of dollars, we need to first divide that by the USD euro exchange rate, which is 1.1302 at the time of recording, and then divide by 1,000, as we want to convert millions of euros into billions of euros. So here we see that the business indicator for HSBC is 54 billion euros. Why would we need that? Well, first of all, that's the proxy of bank size. And second, we use it to determine the bucket where our bank falls into. And that bucket determines what formula do we use to calculate the business indicator component and the ultimate operational capital risk charge. So here are the guidelines that we must follow according to Basel to determine the bucket. So if the business indicator is less than 1 billion euros, then the bank falls within the first bucket, so the smallest type of banks that fall under Basel regulations. And later on, as business indicator increases, we move further up the buckets all the way until 30 billion euros, where the fifth bucket, the largest bucket, starts. So we can see here already that HSBC belongs to the fifth bucket. But if we wanted to determine it using an Excel formula, we could do something like that. We could say if the business indicator is less than 1 billion, then well, our bucket would be 1. Then if it's equal to or greater than 1, then if it's less than 3, then it would be the second bucket. If not, then well, maybe it's less than 10 and still satisfies the criteria for the third bucket. Well, if not, then if it's less than 30, it's bucket number 4. And if it's 30 or higher, then it's indeed bucket number 5. We close a bunch of parentheses and see that indeed the formula gives us the fifth bucket for HSBC, which shouldn't be surprising as HSBC is one of the largest banks in the world, and the fifth bucket has been designed to accommodate these banks such as HSBC as well. Now, why did we calculate these buckets? Well, because the formulas to calculate the business indicator component, that is one of the building blocks of the operational capital risk charge, depends on what bucket are we in. These are the 5 formulas that determine the business indicator component in million euros given certain value of the business indicator itself. So if we fall within the first bucket, then our business indicator component is just 110 times the business indicator. If we fall within the second, then it's 110 plus 150 times business indicator minus 1. If it's the third bucket, it's 410 plus 190 times business indicator minus 3. If it's the fourth component, then it's 1,740 plus 230 times business indicator minus 10. Finally, if we fall within the fifth bucket, it's 6,340 plus 290 times business indicator minus 30. So, what is exactly the logic of those formulas and the buckets? Well, you might notice that this distinction into the buckets is very similar to how the progressive income tax contribution is calculated. We basically have various slopes of the business indicator component for banks falling within different buckets. And it accommodates for the fact that larger banks can generate very high, unexpectedly high losses. So per each billion of the business indicator that you expand further from a certain threshold, you have to increase your business indicator component, that then contributes to the operational capital risk charge, by a higher amount. So if you're very small, then every billion increases your business indicator component just by 110 million. But if you grow larger, this contribution increases. And again, the useful analogy would be marginal tax rate on various levels of income. And those would be basically tax brackets for the banks. But without further ado, let's figure out what is actually the business indicator component for HSBC. Well, we got the fifth bucket, and we have here those components corresponding to buckets with appropriate formulas used to come up with those figures. So we just can use the VLOOKUP function and find which of those figures corresponds to the fifth bucket. So we need to find bucket 5 from the first column and return the business indicator component value from column 4, which is the fourth column is the selected table. And we want a precise match. We want it from the fifth bucket, not one less, not one more. So just put 0, exact match, close the bracket, and see that our business indicator component is indeed 13,269 million euros. So slightly above 13 billion euros, actually. So we have figured out our business indicator component, but that's not all we need to do to calculate our operational risk capital charge. The second and arguably equally important uh, contributor to the final value of the capital charge is the internal loss multiplier. The internal loss multiplier is a value, multiplier, as it comes from the name, that we have to multiply the business indicator component by to get the capital risk charge. And basically, uh, how we can calculate it is from historical loss data of a particular bank. And some banks do report their losses in annual reports or specialized disclosure. But even if your bank doesn't, you can find loss data from academic sources. For example, from Journal of Operational Risk, there are papers that deal with this fact and provide at least aggregated data on average losses of largest banks in the world. Mine is from 2016, slightly outdated, but not too much, so it still can be used with reasonable accuracy to estimate our internal loss multiplier. So we can see that our average loss in millions of dollars is 179. So on average, HSBC's loss is $179 million. But that loss is averaged over a number of years and a lot of various operational risk events. There are very serious operational risk events that are very impactful and that result in billions in losses, perhaps, and there are very minor operational risk events that might result in a couple 100,000, which is not something such a large bank would really care about. Well, they will care about it, but not as much as about some other more substantial loss event. Again, the first thing that we need to do is we need to convert that to euros, as that's what Basel reports all their thresholds and all their formulas in. So we just need to divide that by the exchange rate as for the day of recording, and we get our average loss to be equal to 158.38 million euros. Now, what is, again, complicated and slightly sophisticated about this procedure of calculating loss component is that Basel overweighs significant losses in its loss component. So as we can see here from this formula, we don't just need the losses altogether, but also for losses that have been endured in operational risk events that led to losses of over $10 million, as well as over $100 million. So those are the thresholds we are interested in. And it's hard to get such disaggregated data on operational risk losses. What we can do, though, to kind of avoid this issue of not getting enough disaggregated data, is to assume some distribution function of losses due to operational risk events. And the handiest distribution to assume here would be the exponential distribution. First of all, it's plausible to think that losses follow an exponential distribution. There are a lot of small losses and few very large losses. But what it also allows us to do is, because exponential distribution has zero memory, it means that the average loss that exceeds some value x would be just the average loss altogether plus x. That is the property that's called zero memory of the exponential distribution, and that's why exponential distribution is used to model events in terms of waiting time, for example. If you know that the average time when the bus arrives to the bus stop is 15 minutes, what would be the time that you expect to wait for the bus, given that you have already waited for it for 5, 10, 15 minutes? Well, if you don't have a bus timetable in your hands, or you know that there is a traffic accident or whatever, then the time that you have already waited for the bus does not impact the time that you have still left to wait for your bus. If you want to know more about exponential distributions or other theoretical distribution functions, their properties, and other handy tools from mathematical statistics and how it helps us in economics and finance to model real life processes, please express your interest in the comments below this video and I'll see what I can do. But as for now, we're using the exponential distribution to model average losses and average losses exceeding 10 and 100 million euros. So the average loss is just 158.38. That's why we calculated that. And then given exponential distribution zero memory, it's 158 times 38 plus 10 for losses exceeding 10 million and 158.38 plus 100 for losses exceeding 100 million euros. Now we can apply this formula for the loss component. So 7 times the average loss in general, plus 7 times the losses over 10 million euros, plus 5 times the losses over 100 million euros. And that's it. We can see that our loss component is around 3.5 billion euros. Now, we need to remember what our business indicator component is. Well, we can just take it from over here because we have already calculated it. And then we need to calculate the internal loss multiplier. The internal loss multiplier is characterized by this logarithmic function, and it's the higher is the loss component as compared to the business indicator component. So if the bank is likely to suffer high losses frequently, particularly losses that are higher than 10 million or even 100 million euros, then the bank would be penalized in terms of its operational risk capital charge by having its business indicator component multiplied by a higher internal loss multiplier. This multiplier is the missing element in all past models of operational risk measurement. It reflects the losses that the bank has actually taken without assuming any inherent riskiness to the business lines it operates within. It is still a very aggregated and imprecise technique, don't get me wrong, but it's arguably a step in the right direction when compared to the basic approach and even to the early version of the standardized approach. So the internal loss multiplier would just be the natural logarithm of the number e, which is the exponent of 1, minus 1 plus the ratio between the loss component and the business indicator component. And we can see that the internal loss multiplier for HSBC is less than 1, and it's 0.69. It means that, well, arguably, HSBC is less risky than some of its counterparts, so it would not be penalized too much for its internal losses. And now we need to consider that the internal loss multiplier is applied only to sufficiently large banks. So bucket 1 does not need to calculate the internal loss multiplier. It's done to not burden the smaller banks too much with calculating their loss data and figuring out the loss component and the multiplier, but larger banks are obliged to follow that. So as our bucket is 5, as we already figured it out, we must apply the internal loss multiplier to figure out our capital charge. And here, to figure out our operational risk capital charge, we would have our first instinct to just multiply the business indicator component by the internal loss multiplier. But remember what we discussed previously. Small banks just apply the business indicator component as their operational risk capital charge. To provide for that and to basically provide all banks with correct incentives, just as uh, the progressive income tax rates are designed, we need to ensure that this operational risk capital charge is smooth, so that banks potentially can have an incentive to move from bucket one to bucket two. We don't want a bunch of banks to stay very small, irrationally small, just to avoid additional operational risk capital charges. To provide for that, we need to first of all consider 110, which is the operational risk capital charge, the maximum that banks in bucket one can be asked to reserve. Then we need to add the business indicator component minus 110 to ensure this smoothness, to ensure that the function is monotonous and without any wild swings. And we need to multiply that by the internal loss multiplier. And that's all there is for calculations of the operational risk capital charge. This is the operational risk capital charge for HSBC in millions of euros. So convert it back to billions of US dollars, so to dollars, the currency the company is reporting in. We can just multiply it by the exchange rate at time of recording and divide by 1,000 as we move from millions to billions. So we have figured out that under this approach, HSBC would be required to reserve around $10 billion as Tier 1 capital for potential operational risk events. And that's it for the new standardized approach for operational risk measurement and the business indicator and the internal loss multiplier. I hope you found this helpful. Leave a like under this video if you want to see more videos on risk management and measurement on this channel. Suggest other topics for future videos. I really appreciate your feedback. Don't forget to subscribe to Nuddle. Thank you very much and stay tuned.